If only we had a crystal ball to predict the future of our business, wouldn't that just make decisions so much easier? But while we can't exactly see tomorrow, we can strategically prepare, we can get ready for different outcomes, and, really understand the financial ripple effects of our choices. So today, we're diving deep into cost volume profit analysis, CVP analysis. It's a remarkably powerful tool for understanding how sales volume really impacts a business's financial results. And why are we doing this deep dive today? Well, because we want to give you, our listener, a genuine shortcut, a way to grasp this really critical business concept so you can quickly leverage its power and, importantly, avoid its common pitfalls.
Yeah, and what's fascinating here, I think, is how CVP analysis simplifies these, inherently complex financial decisions. It lets us ask those fundamental sort of make or break questions, like how much do we really need to sell just to cover our costs? It gives you a clear framework for understanding the consequences of different actions.
That's exactly it. It's all about mapping how changes in, sales activity ripple through your entire financial picture. CVP's primary focus is looking at the effects of differing levels of activity on a business's financial results. Think about a restaurant for a second. I mean, in a perfect world, the owners would know exactly how many customers are coming in tonight, what they'll order.
Right. Perfect staffing, perfect food orders.
Zero waste. But that's just fantasy, isn't it?
Complete.
In the real world, every decision, every food order, every staffing choice, it's a calculated guess. It's based on past experience and, frankly, a whole lot of unknowns.
And if we connect that to the bigger picture in the short run, things like your sales price, your material costs, labor costs, those are usually known, or at least known with a fair degree of accuracy. Sales volume, though, that's the big unknown. And that unpredictable nature of sales volume, that's precisely why, in the short run, profitability so often hinges right on it. Take Company A, an example from our sources. They know their sales price for product X is around $50, and variable costs are about $30 per unit. Their fixed costs, $200,000 a year.
Okay.
But if you ask, will Company A make a profit this year? The answer has to be, well, we don't know, because we just don't know the sales volume yet.
Right. Which leads to that crucial question, even before a business, fully launches, how much do we need to sell just to break even? And when we say break even, we just mean covering all your costs, right? Without actually making a profit yet.
Exactly. No profit, no loss, just getting by.
So with all that in mind, how do businesses actually figure that out, that crucial break even point? Well, our sources laid out 3 pretty practical methods they use.
Yeah, the first one is the equation method. It's really just a bit of straightforward math that helps answer a lot of these CVP questions. We start with the basic accounting equation. Total revenue minus total variable costs minus total fixed costs equals profit. Pretty standard.
Right.
And breaking that down a bit more, it's unit selling price times quantity sold minus unit variable cost times quantity minus fixed costs. And that equals your profit P. So for Company A, that would be 50Q, 30Q, 200,000 equals P. And it's important here, like the source mentions, we use total fixed costs, not unit fixed costs.
Why is that?
Because unit fixed costs actually change depending on how much you produce, right?
Yeah.
If you make more units, the fixed cost per unit goes down. But the sales price per unit and the variable cost per unit, we assume those stay constant in the short run, regardless of output level.
Okay, that makes sense. So for Company A, to find the break-even point, we set profit P to 0. The equation becomes 50Q minus 30Q minus 200,000 equals 0, which simplifies pretty easily to 20Q minus 200,000 equals 0.
Yeah.
So 20Q equals 200,000. And finally, Q, the quantity needed, is 10,000 units.
There it is.
So the implication is clear. If Company A sells less than 10,000 units, they're losing money. Exactly 10,000 units, they break even. And if they sell more than 10,000, that's when they start making a profit. It's that simple, but wow, that critical.
Absolutely. Now, the second approach is the contribution margin method. This uses a little bit of algebra, essentially rewriting that core equation, but focusing on something called the contribution margin.
Contribution margin.
Yeah, the unit contribution margin, or UCM, is just the unit selling price minus the unit variable cost, USP minus UVC. So the formula gets rearranged to quantity equals fixed cost plus profit.
All right.
All of that divided by the unit contribution margin.
Okay, let's try that with Company A. Their unit contribution margin is $50 minus $30. So
Yeah.
$20.
$20 per unit.
So to find the break-even quantity, Q, we take the fixed costs, $200,000, and divide by that unit contribution margin, 20. $200,000 divided by 20. That gives us 10,000 units again.
Same answer, different path.
And here's where it gets really interesting, I think. That $20 figure, the UCM.
Yeah.
It tells you precisely how much each individual sale contributes. First, it goes to covering your overhead, your fixed costs, and once those are covered,
then it's pure profit building.
exactly, it's like the profit engine of your business, right?
Yeah.
It gives you such a clear lever for strategic decisions.
It really does. It's a very powerful concept.
Okay, so method number 3.
The graphical method.
The visual approach.
Yep. You plot total costs and total revenue on a graph. Usually, sales and units go on the x-axis, the horizontal one, and dollars go on the y-axis, the vertical one. You draw your total cost line starting at your fixed cost level and sloping upwards with variable costs, and your total revenue line starting at 0 and sloping upwards based on selling price.
And the point where those two lines cross, where they intersect.
That's it. That's your break-even point. Visually clear.
I like that.
And the beauty of this visual, as the material points out, is that the gap between those two lines clearly shows your profit or loss at different levels of output.
Okay. A wider gap above the intersection means more profit.
Exactly. And below the intersection, the gap shows your loss. There are variations too, like a contribution graph. That one emphasizes the contribution margin itself. It shows it as the growing gap between total revenue and just the variable cost line.
Interesting.
And then there's the profit volume graph, which we can maybe talk about a bit more later. It takes a different angle, focusing purely on plotting the profit or loss number itself against volume.
Okay, good stuff. So once you know your break-even point, CDP becomes even more useful, right? You can use it for more strategic things, like figuring out how to hit a specific profit target.
Exactly. We can easily adjust those equations we used earlier to figure out the sales volume needed for a target profit. Let's stick with company A. Say they want to achieve a target profit of $300,000. Using the equation method first, we just put $300,000 in for P for profit. So 50Q minus 30Q minus 200,000 equals 300,000.
Right.
That simplifies to 20Q minus 200,000 equals 300,000. Add the 200,000 to both sides. 20Q equals 500,000.
Okay.
And Q, the quantity needed, you divide 500,000 by 20. That's 25,000 units.
25,000 units to hit that $300 K profit target.
Correct. And the contribution method. Even quicker for this, usually. Remember the formula. Q, fixed cost plus profit, UCM. So Q equals $200,000 fixed cost plus $300,000 target profit divided by our $20 UCM.
That's $500,000 divided by $20.
Which also gives us 25,000 units. Same result again.
Yeah, that's much faster. Now, you can find this on the graph too, presumably.
You could, but the material notes it gets a bit clumsier than using the equations for target profit.
How so?
Well, instead of just looking for where the lines cross, you're looking for the point where the vertical distance between the total revenue line and the total cost line equals your target profit, like $300,000. Harder to pinpoint accurately on a hand-drawn graph.
I see. Makes sense. Okay, let's shift gears slightly. What about managing risk? There's a concept called margin of safety.
Yes, very important.
Tell us about that. It sounds like a financial safety net.
It really is. It's crucial for managing risk because it tells you, essentially, how much your sales can drop before you hit that break-even point and start losing money.
So it's the buffer zone.
Exactly. The buffer between your actual or budgeted sales and, well, financial trouble. The definition is the excess of budgeted revenues over break-even revenue.
Okay, let's use company A again. We know break-even is 10,000 units. What if their budgeted sales are, say, 20,000 units?
Okay, good example. Their margin of safety in units would be 20,000 budgeted units minus 10,000 break-even units.
So 10,000 units.
10,000 units is their buffer. You can also express it as a percentage. That's the margin of safety in units. 10,000 divided by the budgeted units, 20,000 times 100.
10,000 over 20,000 is 0.5 times 100. 50%.
Yep, a 50% margin of safety. Their sales could fall by half before they start losing money. And you can also state it in dollar sales revenue. Just take the margin of safety in units, 10,000, and multiply by the selling price, $50.
10,000 times $50, that's $500,000.
Right. So their sales revenue buffer is $500,000. It's a really powerful metric for understanding your risk exposure.
Definitely see the value there. Now, you mentioned contribution margin earlier. There's also a related ratio, right?
Yeah.
Contribution to sales, or CS ratio.
Yes, exactly. This is often useful, especially when you move beyond a single product. It tells us how much each dollar of sales revenue actually contributes towards covering fixed costs and then generating profit.
Okay, so not per unit, but per dollar of sales.
Precisely. For a single product like Company A's product X, it's simple. You can calculate it as the unit contribution margin divided by the selling price. So for product X, that's $20 UCM divided by $50 selling price.
Which is 0.4.
Or 40%. So 40 cents of every dollar of product X sales goes towards covering fixed costs and profit.
Got it. But what happens when a company sells more than one product? You said it gets more complex.
It does, because different products usually have different selling prices, different variable costs, and therefore different contribution margins and CS ratios.
Right. So how do you handle that?
In multi-product situations, we calculate a weighted average CS ratio. You basically take the total contribution from all products combined and divide it by the total sales revenue from all products combined. So imagine Company A now sells product X, $50 price, $30 VC, $20 UCM, and product Y, $70 price, $40 VC, $35 UCM.
Okay, 2 products.
And crucially, let's say they sell them in a consistent mix. For every one product Y they sell 2 product X's. A 2-to-1 mix in units.
No, mix is important, right?
Very important. Based on that mix and the individual product CS ratios, you can calculate the overall weighted average CS ratio. In this example, the sources show it calculates out to 0.34375.
So about 34.4% overall.
Exactly. And this weighted average CS ratio is incredibly useful because it lets you quickly calculate the overall break-even point in terms of dollar sales revenue. For Company A with $200,000 fixed costs, their multi-product break-even sales revenue would be $200,000 divided by that weighted average CS ratio of 0.34375.
Okay, 200,000 divided by 0.34375 comes out to roughly $581,819.
Correct. They need about $582K in total sales revenue across both products in that specific mix just to break even. And you can use it for target profit too. Say they want that $300,000 profit again, you take fixed cost plus target profit, weighted average CS ratio. So $200,000 plus $300,000 divided by 0.34375.
That's $500,000 divided by 0.34375, which is about 1,454,546 souls.
Right. They need roughly $1.45 million in total sales revenue to hit their $300K profit target, assuming that 2-to-1 sales mix holds.
That's really useful for planning.
It is, but there's a crucial caveat here. We keep mentioning it.
The constant mix assumption.
Exactly. This all hinges on that assumed sales mix staying constant. If the mix changes, say, they start selling way more of the lower margin product than expected, then their actual break-even point will be different. It will likely be higher than anticipated.
So you really need to monitor that sales mix.
Absolutely. It highlights the importance of understanding not just total sales, but the composition of those sales.
Okay, let's circle back to the graphical methods you mentioned, specifically the profit volume graph. You said it was a bit different.
Yeah, the profit volume or PV graph. It's different because it doesn't show separate cost and revenue lines. It plots the profit or loss directly against the sales volume, either in units or dollars.
So the y-axis is profit and loss with 0 in the middle.
Correct. The line starts below 0, representing the loss equal to fixed costs at 0 sales, and slopes upwards. Where it crosses the horizontal x-axis, that's your break-even 0.0 profit loss.
Okay. How does that work in a multi-product situation?
That's where it gets interesting. In a multi-product business, you often see 2 lines drawn on a PV chart, like in Figure 3 from the source material. One line is usually straight. That represents the profit progression, assuming you sell all your products in that constant weighted average mix we just talked about.
Okay, the standard assumption line.
Right. But the other line often bows upwards. It starts steeper.
Bows upwards. Why?
That line illustrates a potentially smarter strategy. Prioritizing the sales of your most profitable products, first the ones with the highest CS ratio. You rank your products by their CS ratio, and you plot the profit, assuming you sell out all you can of the highest CS product, then the next highest, and so on.
So you cover your fixed costs faster that way.
Much faster. That line hits the break-even point, crosses the x-axis earlier, and then climbs into profit territory more quickly.
So looking at a graph like Figure 3, what's the key takeaway?
The visual makes it really clear. When the company sells its most profitable product first, like product X for Company A in the example, which had the higher CS ratio, it breaks even significantly earlier at a lower total sales volume than when it sells products in just a constant average mix.
That seems like a really valuable insight for sales strategy. Focus on the high margin stuff first.
Definitely. The graph shows the potential benefit very clearly.
Okay, this CVP analysis sounds incredibly powerful, a great tool.
Mm-hmm.
But you've mentioned assumptions a few times. Does that mean Well, that we can't always trust its predictions perfectly. What are the main limitations or, the gotchas we need to watch out for?
That's a great question and really important. While CVP analysis is invaluable, you're right, it is built on several key assumptions. And understanding these is crucial because they can definitely limit its accuracy in the real world if you're not careful.
Okay, so what are they?
Well, first, the constant mix assumption we just discussed. CVP assumes either a single product or that the sales mix of multiple products stays constant. If that mix shifts, your calculated break-even point might be off.
Right, we covered that one. What else?
Second, volume as the only driver. CVP fundamentally assumes that changes in production and sales volume are the only things causing revenues and costs to change.
But that's not always true, is it?
Rarely perfectly true. In reality, you might get economies of scale as volume goes up, meaning your variable cost per unit actually drops. Or you might have to lower your selling price to sell more units, which obviously impacts revenue differently than the model assumes. CVP ignores these complexities.
Okay, what's next?
Third, linearity. The models, especially the graphs, assume that the total cost and total revenue functions are perfectly straight lines.
Like constant variable cost per unit and constant selling price per unit.
Exactly. But that linearity is really only likely to hold true within a certain, maybe narrow range of activity, and usually only in the short run. Over wider ranges, those lines might start to curve.
Assumption 4.
The fixed versus variable cost dichotomy. CVP requires that all costs can be neatly, cleanly separated into either purely fixed or purely variable components.
But real life is messier.
Often, yes, you have semi-fixed or semi-variable costs. Think about a telephone bill, often a fixed monthly line rental plus variable charges based on usage, or supervisor salaries that might jump up in steps if you add another shift. CVP struggles with these mixed costs.
I see. What else?
Fifth, the concept of the relevant range. Fixed costs, like the rent for your current factory or office space, are only truly fixed within a certain range of activity, the relevant range.
Meaning if you grow beyond that range.
Right. If your business grows significantly, you might suddenly need to rent a second factory or move to a much bigger office. Your fixed costs then jump up to a whole new level. CVP analysis is generally only valid within the relevant range where the assumed fixed cost level actually holds true and where you have some historical data or a reasonable estimate.
Okay, one more.
Finally, the profit calculation basis. Standard CVP analysis usually assumes profits are calculated using variable costing, also called marginal costing, where fixed manufacturing costs are treated as period costs. If a company uses absorption costing, where fixed manufacturing costs are included in inventory costs, then CVP analysis only works accurately if the number of units produced equals the number of units sold during the period. If production and sales differ, inventory levels change, and absorption costing profit will differ from variable costing profit.
Wow, okay. That's quite a list of assumptions.
It is, and it really raises an important question, doesn't it? Knowing all these limitations, how should we or how should a business approach actually using CVP analysis effectively?
That's the key question. So let's recap. You've just gotten a really efficient overview, a shortcut to understanding cost, volume, profit analysis. We've gone from calculating break-even using different methods to setting profit targets, managing risk with margin of safety, and even tackling multi-product scenarios with CS ratios and PV graphs. You now have a handle on not just the what, but the how and the why behind this fundamental business tool.
And maybe a final thought to leave you with, building on that last point about assumptions. Given CVP's reliance on these simplifying assumptions, linearity, constant mix, fixed versus variable splits, how might a business best leverage its insights? Perhaps not as a tool for generating exact, rigid predictions, but more as a dynamic model for asking what-if questions. What if our costs change? What if our sales mix shifts? What if we lower our price? Using CVP for scenario planning rather than just forecasting.
That's a great point to ponder. Keep diving deep.